Hi, frequently we get questions, what's the difference between an exchange-traded fund, an ETF, and a mutual fund? What makes them different, and which is the better option? Well, my name is Mike Rogers. I'm the president and founder of 360 Financial, and this is another 3 minutes with 360, and we're going to cover exactly that topic. So first of all, let's look at the structure. A mutual fund is a pool of money, and the pool of money is managed by somebody, usually a money management firm, and that could be an index approach or it could be managed differently against the index. But through that, what they're trying to do in this pooled investment is determine the investment objective or to meet the investment objective that's laid out by the prospectus. Okay. What's the goal of the fund? What type of investments are they going to be making? Okay. And the management company will determine which stocks and which bonds to buy. Okay. ETFs, kind of on the other hand, work almost the opposite. This investment company will create this exchange-traded fund, and they'll move a block of shares, whether those are stocks or bonds, into that specific investment objective, and then they'll trade those stocks within the portfolio, or those bonds within the portfolio. So they, again, look very similar, but pricing is different on them. Mutual fund prices once at the end of the day. So if you look at a traditional 401k plan, you usually have a lineup of different mutual funds, what I like to call traditional funds. Okay, those price once at the end of the day. So if you decide at 11 o'clock in the morning you're going to sell a fund, you still only get priced at the end of the business day. Here in Minnesota, it's Central Time, 3 o'clock. East Coast, it's 4 o'clock. Okay, mutual funds, then with that pricing will determine what your value is at the end of the day. An exchange-traded fund trades on an exchange, and therefore it trades like a stock in the fact that there's updated pricing throughout the entire day. Okay? So when you buy at 11 is what you actually buy or sell that investment for at that time. Okay? So this could have obviously some potential benefits to a person who's making investments because they know exactly what the price is that they're buying or selling that ETF. Okay. From a tax advantage standpoint, mutual funds tend to pay out capital gain distributions towards the end of the year, and are not as tax advantaged as exchange-traded funds. ETFs will pay out capital gains, but mostly when you sell the actual ETF. So we can manage the taxable situation better with an ETF than an open-ended or traditional mutual fund. So which one's better for you? You know, what I would recommend is that you talk to your financial advisor, you look at these different benefits and the cost structure of each and determine if there's a good fit in your portfolio to make some changes. Of course, you can always contact us here at 360 Financial, and we'd be happy to answer any questions that you have. In the meantime, thanks for tuning in to another 3 minutes with 360, and we will see you at the next segment.